In Chapter 11, we look at using relevant costs to make short-term decisions. We focus on the 5 steps in the decision-making process that we've seen in other chapters. So, of course, our first step is to determine what the strategy is. Second, specify what we're looking for and identify any alternative actions. Then the third, we want to look at the relevant information and make our decisions from the best course of action, and then come back and evaluate that process. So in relevant cost analysis, we're looking at a future cost that differs between or among decision alternatives. So relevant costs can be variable or fixed. Generally, variable costs are the ones that we're looking at. Relevant cost analysis and total cost analysis produce the same results. Relevant costs are also referred to as avoidable costs. They're also sometimes called incremental costs or difference costs. A sunk cost is a cost that was incurred in the past or committed for the future, and sunk costs are not relevant for decision making. So when we look at what is relevant or not relevant, so costs that differ among options, not relevant for those costs are committed or sunk costs. So example, the cost of shopping for a new automobile, the difference in the cost to travel to the different auto dealerships is not a relevant cost. What is relevant is the purchase price of the new automobile. If we have costs that don't differ among options, those costs are not relevant. So if I would pay the same cost regardless of what decision I make, then those costs are not relevant to my decision. So what are relevant are the costs that are different between the two decisions. If we look at this equipment replacement decision example and need to decide which costs are relevant and which are not, so we have the original cost of the old machine, the current book value of the old machine, purchase price of a new machine, salvage value of the new machine, repairs to old machine, which would allow 1 more year of productivity, how much it costs to operate both machines, that the new machine will reduce labor costs by 50 cents per hour, and the expected level of output for the next year is 2,000 units. So we want to look at these and determine which are relevant and which are not. So we cross out every cost that is relevant. So the only things that are relevant are the things that happen if we make the decision to purchase a new machine. So the purchase price of a new machine would be relevant in that decision. The fact that the new machine will reduce labor costs by 50 cents per hour is relevant to that decision. The other thing that is relevant is that we can repair the old machine, which would allow it to work for 1 more year. And that repair cost is half the cost of the purchase price. So then we need to determine which one of these is the better option, repairing the old machine or purchasing a new machine. If we look at the labor costs, if we repair the machine, our 2,000 hours will cost $10, or 2,000 hours will cost $10 per hour. If we replace it, we're going to save 50 cents per machine. That's a savings of $1,000 in the replace minus repair option. Our fixed costs are $3,500 to repair the machine or $7,000 to buy a new machine. So the difference between the two options is $2,500. So we want to decide if we want to replace that machine. We then put in the total costs. So the things that don't change, which are the power, which is the same regardless of which decision we make, and depreciation costs, which is the same regardless of which decision we make. Either way, we will save $2,500 if we repair the old machine and continue to use it for one more year versus buying a new machine. Additional considerations we need to make when we're doing relevant cost analysis are that batch level cost drivers should be considered. So if setup on one machine takes longer and requires more skilled labor than the other machine, those are things that we should factor into our analysis. We also need to think about opportunity costs. So opportunity costs are the benefits lost when we choose one option over the other. So for example, addition of a new product could cause a reduction, delay, or lost sales in other product areas. Or in a make or buy decision, if we decided to outsource something, we would have extra factory space that we could commit to something else. So what is the opportunity cost there if we decide to outsource? Other things that we need to consider is that depreciation is not included in a relevant cost analysis, except when we need to consider the tax implications of cash flows. The time value of money is relevant when decided with cash flows over 2 or more years. We're going to look at the time value of money in Chapter 12 when we look at capital budgeting decisions. We also need to think about if there are differences in quality, differences in functionality, any timeliness of delivery, reliability in shipping, and any after-sales service levels in some of these decisions. For example, the make or buy decision. If we make it in-house, we control the quality and the timeliness of having that material. If we outsource it, then we no longer control the quality. We rely on our vendor to give us good quality, or the delivery, we rely on our vendor to have it to us in a timely manner. So in this strategic analysis, we only identify the relevant costs. We don't want to, by only identifying the relevant costs, we might fail to link the decision to the firm's strategy. So when we talk about the advantageous of a make or buy decision, it might be advantageous to outsource production based just on the relevant cost information. But this might be a poor strategic move if we can't guarantee delivery of the product, if we can't guarantee the quality of the product, if we have issues finding suppliers who can provide the product in the way that we want. We also have to think about any opportunity costs of what we could do with that other product area. So relevant cost analysis is a short-term focus. It's not necessarily linked to strategy. It's a cost focus, and it's focused on individual product or decision situations, where strategic analysis has a long-term focus, is linked to the firm's strategy, and considers the customer in all things. So we need to find a way to combine our strategic focus with our short-term relevant cost analysis. We're going to look at several different relevant cost analysis management decisions. The common decisions are whether or not to accept a special order, whether or not to lease or buy, the decision to sell a product before or after additional processing in the joint processing decision, if we sell at the split off point or process further. The short-term product mix or service mix decision. So capacity constraints. If we have a capacity constraint, which product should we focus on? Then a profitability analysis, whether or not to keep or drop products or services because they're not currently making us money.